Hi everyone, how are we going? Welcome to our webinar. Our webinar today is on buying a business, how to successfully complete the sale. My name is Brinley Meagher and I'm a lawyer in our LegalVision corporate team, and I'm joined today by my colleague Matt DeRusha, who's a senior lawyer also in our corporate team. Before we begin, we have a couple of housekeeping items. So essentially, you'll receive the recording and the slides in your email after the session. Please submit any of the questions that you have in the chat box, and we'll answer them at the end of our session. And then finally, please complete the feedback survey after the webinar, because it allows us to improve on our next session and also let you know anything that you're interested in hearing more about. Also, all attendees will be eligible for a free consultation with us, and this will essentially let us know how we can help your business's legal needs. So we'll be able to help you out with any contracts and things like that. So to request your free consultation, please provide us with your contact details in the survey that appears at the end of the webinar. So to get us started, today we'll be talking about how to buy a business, essentially how to successfully complete the sale. We're really focusing on the practical tips and practical sides of this. So we'll be going through a bit of the sales process, the due diligence, the contracts, protecting yourself and your business from future risk, and then going through the exchange and pre-completion steps, settlement and completion, and then finally some key takeaways that we think will be really important for you. So Matt, do you want to get us started?
Thanks for that, Brinley. So I'll take us through an overview of the sale process. Some of you guys might be familiar with the sale process or know some of the basic elements, but we'll walk through all the steps just in case. So the first step is obviously finding the right business and finding a target acquisition. And then after that, we'd be looking to, well, the seller would be looking to enter an agreement to make sure that if they're providing you documents, then there's confidentiality attached to that. So that's done by signing a non-disclosure agreement or confidentiality agreement, which we'll go through later. The next one would be conducting evaluation, so doing the financial due diligence on the business to make sure that the value adds up. We'd be then potentially looking to do an offer sheet, or otherwise known as a heads of agreement. This isn't always done, but is sometimes a useful step to agree to the basic commercial terms in terms of price, earnout, and some of the other key metrics. After that, we'd be looking to do a due diligence on the business. We'll walk through this in quite a bit of detail, basically to make sure that there is no skeletons in the closet. Following that, if we're satisfied with the due diligence as the buyer, we'd be looking to draft and negotiate the sale of business agreement. This is a long form document that sets out all the terms and conditions about the various assets you're buying, the employees, the equipment, contracts, etc. After that's signed, there's usually conditions precedent that need to be satisfied. These are basically things that need to happen before the sale can complete. So these include things like taking over the lease, or engaging key managers, or releasing security interests, which we'll explain later. And then completion, this is what we refer to when the business is actually handed over, and that is when the purchase price is paid by you. Excellent. And over to Brinley.
Fabulous. So as Matt clearly outlined, usually the first step in this process before you enter into any due diligence is the NDA stage, which is non-disclosure agreement, also known as confidentiality agreement. Often this is provided by either party to make sure that you're protecting your business's confidential information. So that could be things to do with key staff, financials. It also could be to do with different licenses that you hold, the way that business operates, making sure that you are really protected when you're going through these phases. We would always say that the non-disclosure agreement binds the buyer and the seller to essentially keep the information private between the two parties. So ensuring that there isn't any information spread, making sure that, say, if there is an industry competitor looking to purchase the business or wants to know what the moves are with the business, that really keeps that information quite private. But what it also will mean is that you will need to understand what this document means. So within the document or within the NDA, it'll have some really clear terms. It'll be what information is kept private, who it needs to be kept private by, and how long it stands for. So we will essentially say that prior to signing anything, either make sure that you're getting us to review the document, or really understand the terms in this document so that you know what information you will be receiving, what information you can share, and who you might be able to speak to that to. The next stage is, as Matt mentioned, the heads of agreement. So this is the term sheet, letter of intent, heads of agreement. Some people call it an LOI. There's lots of different names, but essentially it's a non-binding agreement. So it means you're not legally bound to the terms that you agree on within this document, but it is a really good commercial document for you to understand what it is you're buying, what's included in the sale, how long some of the commercial terms are within the document, and essentially the way that you're purchasing. So usually they're the key things that are included in that. It will often outline the different types of finance that you might be looking to either obtain or purchase the business for. But what we want to reiterate to most people that are looking to buy a business is, although this is a non-binding agreement, we would always say make sure that you're satisfied with the commercial terms of the document prior to signing, because renegotiating a contract once you've agreed to certain commercial terms is so much harder than had you just negotiated that prior to signing this particular document. But once this document is signed, you'll enter into the due diligence phase, and Matt's going to talk us through that now.
So due diligence is really the key stage we want to focus on as a buyer. This is a formal process, and it can happen at various stages throughout the process. So as a buyer, we want to conduct this due diligence as early as we can. So there's various times that we can conduct that due diligence. And really, it's the seller who's concerned about the confidentiality obligations. So us as the buyer, we want to do it potentially after the NDA is signed, or at the very least after the heads of agreement is signed. We don't necessarily want to wait to sign the sale agreement before we're actually starting to investigate the business and looking through the contracts, financials, etc. Because if we find something, we've spent a lot of time and effort and money negotiating contracts, and we might not be happy to proceed, and we're not going to generally get any of that back. So basically, throughout the process, the seller might have a broker. They might provide you with a information memorandum, information setting out about the business, and that will be framed in a very positive light, of course. So during due diligence, we want to verify those claims. We want to make sure there's no hidden skeletons in the closet. So these include, really what we want to focus on is where does the business derive its value from? And so we want to focus our due diligence investigations on that. So if it's ongoing customer contracts that are locked in, we want to review those customer contracts. We want to make sure they're actually locked in. We want to make sure they're not subject to any unfair contract terms or other things that might allow those customers to get out of those. And we want to just verify those claims. So there's a couple different categories of due diligence. Obviously, we can help with what's called legal due diligence. This is reviewing contracts, reviewing employment agreements, reviewing employee entitlements, and making sure these all stack up, as well as make sure that doing searches on the business, so litigation searches, as well as PPSR searches. And then, sorry, next slide. Oh, thanks for that. And so the key thing here is about security interest or PPSR searches. We want to do this search as early as possible. So if we're buying the assets of the business, we want to make sure that the seller owns those assets and no one else has a claim over those assets. So usually if a seller has taken out a bank loan, then the bank will take security over the whole of the business. That means that we can't take over those assets until the bank has released those security interests. So this is a key part that should be done early, can cause issues later on if it's not done. We want to make sure that it's all released. And here sets out a couple other examples of what we would be doing around due diligence. Obviously as well, thinking about IP, if that's where the business derives its value from in terms of trademarks, etc. We want to do searches to verify the seller actually owns those. So we'll hand over to Brinley.
Fabulous. So after we're satisfied with the due diligence phase, as we've mentioned, the next stage is the contract stage. So what we want to emphasize through this particular slide and through this stage is that the seller is going to provide you with a contract for sale, as well as some other transaction documents. And this is the key one to protect yourself legally. So often, if you haven't engaged us prior, this is usually where most of our clients will be engaging us to make sure that the commercial terms that they've agreed upon are reflected within the contract. I mean, there is a very rare instance where buyers will draft the contract for sale, but most of the time it will come from the seller. So usually you'll be receiving that document. And there's just a couple of different things that we want to emphasize through this. And apologies for the legalese, but these are the terms that you will identify within those documents. And I think that it's really important to actually note them as they are. So the first is warranties. So warranties are basically the promises that the seller is providing or making to you about the business. The indemnities is basically how you can collect on those promises if they're not met or there's any obligations that they don't fulfill. Following that, there can also be potential personal guarantees. So the personal guarantees can be in a couple of different ways. They can be to do with the finance, they can be to do with some of the warranties that are provided or any other obligations that you've made within the document. There is also quite an important point, especially if you're buying a business from another industry professional, someone that's been in the same industry as you for a long time, or maybe even someone that you see as a potential threat if you buy the business off them. And that's the restraint of trade. So the restraint of trade will mean that that particular individual won't be able to go out and start another business in the same sector and take clients away from you or compete with you in any way. And so we'll make sure that there's some reasonableness to that, but it is a really important point within the contracts phase and something that we wanted to emphasize. And then finally, another point here is around payment and payment adjustment. So often within your term sheet, you'll have your payment price. And there's different ways, as we've mentioned, that you'll be able to do that. But in addition to just the payment price, there may be some earnouts or retention payments or escrow payments. Basically, your earnouts are to do with revenue. So maybe if there's a revenue bonus or incentive that you'll be paying to the seller after the sale, that will be outlined in the document. A retention payment can do similar, but also can retain the seller for their services within the business after you take over, which might be quite handy if you're new to the industry or if there's a particular customer base or there's a longer transition period. And then finally, around the purchase price adjustments. Adjustments are really important to consider because they will mean that there might be a reduction in the purchase price because of certain factors. And that might be because of employee entitlements or outstanding tax bills or anything like that, which is where if it is a more complex transaction, we would say have a really good team, your accountant, your lawyers, have a look at the due diligence documents prior to receiving the contracts so that we know whether there will be any adjustments to be made. On the next slide, we want to emphasize the importance of protecting yourself from future risk, because I think that this is probably the most practical point through buying a business. Essentially, what we would want to do is make sure that you've got a really good strategy going into the sale so that you can undertake thorough research, you can prepare business plans and financial models, and you can understand past performance so that you can have a really realistic outlook of what it might look like for you to take over this business. Like, do they have contracts that are worth a couple of $1,000s each that all end in 12 months that don't have a renewal on them? Is the business revenue contingent on those sorts of things? And that feeds into this point that Matt and I both think is really important around overpayment. So we think that when you're looking to buy a business, the due diligence process, probably the most important prior to receiving the contracts, gives you a really good understanding of the price of the business, where the value is derived from, and what it will allow you to do is really understand whether you're paying a fair price. Or if you think that you're maybe overpaying, is there other factors that are coming into that? Are you quite emotionally attached to this type of business? Is this a goal of yours or a dream of yours or something like that? That means that you're paying a little bit more than maybe what some other people on the market would want to pay for the business. And we can absolutely have those conversations with you. You will be also advised by your accountant through this process as to particular types of value. But the additional factors on that would be what you're paying for goodwill. So that's definitely something to consider. Once you've gone through that process, we're then going to get to your exchange and pre-completion steps, and Matt can talk us through those thoroughly.
Thanks, Brinley. So when it comes to exchange and completion, exchange is what we refer to as signing. So signing and exchange, which means the same thing. And really at that stage, we've negotiated all of the terms, we've done due diligence, we've sought to address some of those risks through the warranties and indemnities like Brinley has gone through. And we have a finalized version that sets out basically a roadmap for the sale and segregates the risk to both parties. And when that risk is kind of segregated, usually the seller is responsible for the risk before completion, and the buyer is responsible for the risk thereafter completion. And there can be slight changes to that in terms of, variances between different types of businesses and the like. So really, we want to make sure, one, that the seller has gone through all the corporate governance approvals. So in some instances, it will require shareholder approval and certainly director approval for a company to sell a business. So we want to make sure that they have done those approvals. As well, obviously, we're making sure all of the conditions precedent are satisfied. These usually relate to a transfer of a lease. Obviously, for you as a buyer, probably finance, right? That you've obtained finance. And that maybe we are engaging key staff going forward and making sure those key staff have signed and returned employment agreements. The next here is release of encumbrances, so making sure that all of the assets are able to be sold by the seller without anyone else having a claim, like I briefly talked about before. And that search should be done earlier, but sometimes these releases are done around completion. And it gets a bit tricky when we talk about things like equipment leases or equipment finance arrangements if you're taking those over. So sometimes it'll be the case that you seek to take over those arrangements, that say there's a printer or say there's a piece of machinery that is being financed over time. You potentially can take that arrangement over, although in my experience, a lot of these companies are resistant to that. And the more practical approach is that it's actually paid out and that you obtain full title to those assets and that you pay that portion directly to that financer at completion. So part of the purchase price goes to the seller and part goes to the financer. And we want to make sure that all of those assets are free of encumbrances. The next is a stock take. If it's stock-based business, we want to make sure that we've done a stock take, we've valued the stock, both the seller and buyer have agreed to that value, and usually the sale agreement will set out what happens if they don't agree. Usually an independent valuer will come in. And then as well, third-party approvals. So if there's contracts with suppliers or customers, and under those contracts, those individuals or entities need to approve the transfer of those arrangements, then we want to make sure that that's happening. Or if there's change of control clauses in certain contracts, we want to make sure that's all done. And then lastly as well here, so in the lead up to completion, there can typically be an adjustment to the purchase price. So usually this will be for employee entitlements. So if you're engaging the employees on and from completion, you will typically take on those entitlements and to long service leave, annual leave, and sick leave. And there'll be an adjustment to the purchase price. And there's different percentages that are done for those. Obviously, sick leave, we're not going to pay 100% for that because employees typically won't use all their sick leave. So that's typically kind of 10 to 30% that you'll that the purchase price will be adjusted by. So there's the purchase price moves downward, so it's reduced, and you take on those entitlements. As well, this can be for council rates or other utility bills, and for other things unique to the business. There could be adjustments for that. And Brinley will take us through what happens after the sale.
Thanks, Matt. Well, this is the exciting part, guys. It's after the sale, you're taking over the business, but don't forget that there are still a couple of key steps at this stage. Some of which are commercial, some of which are practical, but still there might be some legal steps here. So it's really important to take note of these things. And if you are going through this process, make sure that you've had really thorough conversations with your entire team so that you know exactly what will happen after the sale. So what we want to ensure is basically that we have an effective integration of the business that you purchased. So make sure it's really smooth. And we think from our experience, the best way to do this is to emphasize ongoing communication. And that would be in communication with your new employees, maybe even some employees that you're rolling over, and making sure that there is clear communication between yourself and the seller or anyone else involved in this process so that if anything goes wrong or you wanted to ask some questions or anything like that, it's really clear and it makes it easier for you to adapt to any sort of challenges that might come your way. What usually happens at this stage, and as we've previously mentioned, is sometimes the seller will want to do a handover period or will do some training or maybe stay in the business for a while. And this is usually where this happens. If it hasn't been entered into within the sale agreement itself, we usually advise to get either an employment or a contractor agreement or something along those lines in place. I'm more than happy to help you drafting one of those so that you have a really clear understanding of what that person's role is in the business, how they're going to help you, and it'll make this process quite smooth. At this stage as well, there'll also be those deferred payments, as we've spoken about, that might come to do with some revenue, maybe any deferred payment to secure your interest in the business or anything like that, that has been set out within the conditions of the contract. But look, I think that the emphasis here is that this is an exciting time. Although there's some things that still need to happen through this period, just enjoy running the new business, make sure that all the hard work's been done prior so that you can have this smooth transition period and enjoy your success. Matt's got a couple of key takeaways that I think between us we think are really important. He can run through those.
Thanks. Well, firstly, thanks for making it this far with us, everyone. But I think it's really important with kind of sessions like this that there is some key takeaways, because a lot of time there's a lot of information, but it's important that we have a couple key things that we can actually take away and remember. So that's the purpose of these. So I think the key one here for you as a buyer is determining where the business derives its value from. Right? Are these customer contracts, or these ongoing arrangements with suppliers, and really kind of honing in on that. So through the due diligence, then we can seek to make sure that those arrangements stay in place. We start the due diligence as early as possible, and then we can determine what the risks are. If there's a reasonable amount of risk, then we can actually address that through the sale contract. We can seek to get, promises from the seller. We can get indemnities, and we can potentially get personal guarantees from the individuals who stand behind the company that is the seller, right? So that's the individuals actually saying, well, we're promising a bunch of things. I stand behind this personally, and that means if those aren't true, then you can bring a claim against that individual personally. So people are more wary when they're standing behind it personally to be very upfront and truthful about what is actually going on behind the scenes. And then, as Brinley's gone over recently here, we want to ensure that the seller stays on for a period after completion to make sure that you can hand over those relationships with the customers or employees or suppliers, and as well to make sure that you know how to use the systems and processes that the business uses. So those are the four kind of key takeaways there. Hope you can find some of them useful. Brinley will take us through a couple of housekeeping things at the end here.
Yeah, thanks everyone for joining us so far. There's still a couple of points that we wanted to discuss with you before we get to some questions. So that obviously concludes the main part of our webinar. We've also included here a QR code for one of our publications, which is Buying a Business, a Guide to Negotiating Terms, which we've spoken about a little bit briefly, but this is in much more detail. We're going to answer your questions shortly, but while we allow you to submit them, we just wanted to take a quick minute to talk to you about LegalVision, and as well to let you know that we have an upcoming webinar. So our next webinar is around employee incentive schemes, the alternatives to startup concessions, which we've had an internal session about, Matt and I, only recently, and we found it really useful. So we think that it will be really useful for you as well to understand what other options you have within the business. That'll be held on the 1st of November at 11 a.m. So to give you a little bit more information about LegalVision, essentially we are a membership-based law firm that is a cost-effective alternative to legal services. We are very unique in that respect, and we allow our clients to have unlimited documentation, drafting and review for business as usual needs, which also allows you to have unlimited consultations for legal advice. This is across all sectors, not only corporate like we've been discussing today, but things like trademarks, intellectual property, potentially disputes, things around employment. So there's so many areas that actually involve your business that you'll be able to chat to us about. All of the service costs around domestic trademark applications are included, and we have a couple of guarantees for our clients as well. So we've got guaranteed quick turnaround times, that we will provide on the spot, so our clients exactly know how long things will take us, as well as a fixed affordable monthly cost. So you can project these things or even build it into your financial models of taking over this new business. We are very lucky in that respect, and we also allow for a number of different areas of law, so you can come and chat to us about anything if you've got an interest or a question. But we do think that our clients get a lot of value out of that. So now we'll get to some of the questions. Matt, if you'd like to take us on.
Yeah, thanks, Brinley. So we've got a couple of questions so far, but feel free to take a moment now and put some through. It's always useful to try and give you guys a bit of value add personally, although maybe those questions can also apply to a couple different people. We've got an interesting one here, the first one that was sent through. It's about buying an online business and how do we make sure that we can have a transfer of the digital assets like domain names in a way that protects people from bad players, is how it's been put. So essentially, sales can be risky if you're not meeting let's say we're the buyer here. If we're not meeting the seller that owns the online business and they're potentially in another country, there's inherent risk with that. Now, the one way that we can deal with that is to engage a lawyer and have a lawyer on the other side who will provide communications with your lawyer about whether or not they hold access to those domain logins themselves, and they can verify and they can provide undertakings that they have the access, that they've used them, or that they are valid, and that once the purchase price is paid, that they will hand over access. So through lawyers, especially obviously in the same country, we have an ability to, we're bound by codes of conduct and professional obligations. So that's really one way that we can protect ourselves, by engaging lawyers and making sure there's a lawyer on the other side. And we've got a couple more other questions rolling in here. The next one is about valuation and business values. It's an interesting one, and it's, what are the methods for calculating a business value? Bit of a tricky one. I guess the answer is there's a number of different ways. We ourselves are not business valuers, but we certainly see how it plays out. A lot of time this can either be tied to a multiple of EBITDA or profit that, probably 2 to 3 times the profit of the business is what we're seeing for the most part. And because a buyer of a business usually wants to make its money back within that time, usually it could be up to 5 years, it could be 5 times EBITDA, and so that you're making your money back within 5 years. The other times that we see it can be tied to revenue. So we see that for some of the accounting practices that we've dealt with and sold recently, that the purchase price of the business is tied to the revenue that they're bringing in.
Ooh, I'll answer. Yeah, we've got a couple more coming in. I can answer the next couple. So one which I think is really important is, what are the key legal and compliance requirements post-acquisition? We also said excluding the necessary ASIC detail changes. So there's a number of different things here that we think are really important. Obviously, ASIC is one of them, updating ASIC around the owner of the business and those sorts of things. But there's a number of different assets in the business, as we've spoken about and Matt's just referred to about the digital assets. We also have things like your employees, your ongoing contracts, and those sorts of things as well. And it's a matter of making sure that we can actually document and keep on record the owners of those particular things. So if a key contract is quite valuable to you, if you don't actually allocate it to the business properly, then that contract can continue either with the previous party, or it may even just cease altogether, and then you've lost the value of the business. So that's one of the things that's really important. There's also a number of steps around the digital assets, or even things like trademarks, where there are a number of requirements to actually have legal documentation for transfers or assignment, those sorts of things in place. Otherwise, for example, IP Australia won't actually transfer a trademark across, or a design registration, or a patent, or something like that. So having this documentation in place will be really handy, and they are some of the things that post-sale you actually might need to get additional documentation for. So you may need to have those assignments done, or there may need to be a really clear agreement in addition to the sale contract that will allow you to actually transfer something. Another question is, what are the usual mistakes that contracting parties make without the help of the legal team? I think that sort of ties into the previous question in having the correct documentation in place to know how to deal with assets of the business or even just the way that the business functions post-acquisition is really important. We also think that most of the time, as we've identified, some of the terms in these contracts are just confusing or don't really make much sense unless you see them all day, every day. And we're quite lucky in that we are looking at these things so frequently that we understand what they mean, but not just in legal terms, in practical terms. And you might read something like that within a contract and not actually know what that means for you practically. So I think the most important part is when you don't have a legal team in place, you might be agreeing to something that you don't actually understand in practice. So that's why we often say, get a legal team to look at these documents. There might be a guarantee or something within the document that says you have had independent legal advice, and signing off on that when you haven't is also an issue there.
All right, we've got a couple more questions here. We'll try and answer them all because we know that's what everyone likes. So the first one is about employee entitlements. Touched on sick leave, but how's long service leave and annual leave handled? So if the employees are continuing with the business from the purpose of the Fair Work Act and accrued service, you need to recognize certain entitlements. So annual leave is the only one that can actually be paid out. But typically employees don't want that because they're going to have plans to taking a holiday after the sale at some point, and we don't want their annual leave balance going to zero because practically that doesn't really work. So usually there's an adjustment for everything, and that typically that will be adjusted at 100% because most employees will take that. So if they're being paid $1,000 a week and they have 1 week of annual leave, the purchase price would be adjusted or reduced by $1,000 because you're taking that on. In terms of long service leave, that's usually pro rata as well. So in different states, there's different requirements. In New South Wales and Victoria vary slightly, but generally after 5 years, employees start to accrue it. So usually we'd only be looking to have an adjustment after they're with us, they're with the business for 5 years. And then it's potentially, a range of adjustments being that at that it could be 35%, and then after 7 years that they're adjusted for 50%, because the closer they are to 10 years, and 10 years is when you can actually take it, the more likely you as the buyer are to actually incur a liability when they take that. Now, I think times are changing. People are less likely to take long service leave because they're moving around more often, so that's something as well to deal with. The next is, how do we determine if tax is payable on a customer list? We have a tax team that deals with these kinds of things, but generally what we'd be thinking about here is, I think from the buyer point of view, we'd be thinking about whether GST is applicable. Typically, GST isn't payable if the sale is a going concern. So this means that all of the assets necessary for the ongoing operation of the business are being transferred over. And so if it's just a customer list we're buying, then that's not all the assets, that's just a singular asset. And typically GST would be payable. With that GST, you usually get that back in the form of a tax credit. So you pay it out, say it's 10 grand worth, you would typically get that back when you are required to pay the ATO the next $10,000, and that you're not having to pay that first $10,000 to the ATO. Next is, how do we evaluate reputation value or goodwill? Usually goodwill value is everything left over that's associated with the business. I'm not sure there's a real scientific way to actually calculate this, but if the purchase price was $1 million and all of the assets add up to 500 grand, then typically we would be saying that there's $500,000 of goodwill. Again, this is more of an accounting tax point that luckily for us, we don't have to sort out. But yeah, it's a bit of I think more about an art than a science in terms of goodwill. And lastly, we've got follow-up on entitlements. If you cease the new entity and change the employees over to a new entity, what impact does this have on long service leave? So in a business sale, usually the business is transferred to a new entity, the buyer. And for the purpose, if it's continuing to operate the business, it will be looked at as if it's a continuing business and that employee has continued to work for that business. If you do an internal restructure, I think things get a bit more complicated, but generally where there's no kind of gap in employment, and usually we'd be thinking around kind of 45 or more days, then you're having to actually treat them as if they always worked for you, and that you're having an adjustment in the purchase price to deal with those liabilities that you potentially have to pay out for annual leave, sick leave, or long service leave. We've got a couple more questions here. We've got another one about what is the biggest roadblock to completion that we typically see. And I think this relates also to the other one we touched on earlier, the usual mistakes that contracting parties make without a legal team. So I find that the PPSR search and making sure that the seller owns the assets, either that's not done early enough or at all, or is done late in the process, and we're only finding out about it when completion is supposed to happen, and that the bank actually, has a ownership rights or potential ownership rights over the assets of the seller. And that as the buyer, we're then thinking about, do we want to go ahead with the sale? When are we going to get that release from the bank? Are they actually going to try and take back those assets? So that causes a lot of concern and stress in the final stages. And so doing that search early on is really key. And yeah, we've got another one here about transferring over a lease and asking about what happens if a landlord won't agree to actually transfer over the lease. So this can be a difficult piece here because we're dealing and relying on a third party being the landlord. Landlords aren't always, forthcoming in their, desire to help out a buyer and a seller with a business sale, because if they're getting rent now from the seller, they're going to be getting rent after when you become the buyer and owner of the business. And so for them, there isn't much value in the business sale necessarily, unless they see, longevity with you as a good reputation of the buyer. So really, whether or not they can block the transfer of the lease come down to whether it's a retail lease or a commercial lease. Retail leases deal with, well, they have specific legislation that sits behind it to protect lessees or people that hold the lease and make sure that they're treated fairly generally. So landlords can't unreasonably deny a transfer of a lease if it's a retail lease. But if it's a commercial lease, they actually do have an ability to block a transfer of that lease.
I think the final question here today, that if you've got any more, feel free to pop them through and we can take them offline and bring them back to you after the webinar. The final question is around, what do you do if your key contracts aren't actually documented? I think this is a really important point, considering if you're going into, say, a manufacturing business or a wholesaling business or something like that, and the key contracts or suppliers don't actually have a documented relationship. It's just a relationship that they've had for the last 10, 15 years. What do you do with that? I think one of the key points that we mentioned in there is around that handover and making sure that either getting a contract in place or trying to put something new in place once you've taken over would be the ideal situation. If you can't do that beforehand, or potentially this contractor or supplier is a bit old school, having that transition period with the seller will be quite good to develop that relationship so that you can continue that attributed value within business and continue to operate in the way that it previously had done so. That might not necessarily mean you want to continue with that supplier or contract, but if that's where you see some value in the business, it will be really important to have that good relationship both with the seller and with the contractor or supplier, and making sure that you can continue that relationship. Hopefully, in an ideal world, after a bit of a handover period, they'll be happy to put in something in place so that you can secure some terms and make it a little bit easier for you to understand how you'll be running the business and how that relationship works. So we hope that we've answered all of your questions so far. If you've got any other questions, as mentioned, please feel free to send that through. Oh, there's one more here that I think we do have time for. So what is the recourse for an incoming purchaser if the lease is not transferred across or is simply missed? Matt, you're a bit more of an expert in this. Do you want to answer that one?
Yeah. What is the recourse for incoming purchaser if the lease is not transferred? Well, yeah, I mean, if the lease is, I guess what we're talking about when we miss the lease is that there's a premises and you as the buyer taking over the business and going into that premises. So really, you'd need rights to actually enter that premises. And a lease or sublease is really the only way you can do that. Usually a sublease will require the landlord's consent to that in any event. So really what happens is that if you paid X number of dollars for the business and there's goodwill attached to the actual location, being that customers know where it is and they frequent it or whatnot, you essentially don't have rights to stay there. And that's a breach of the lease by the seller because they've allowed someone else to go and enter that premises. And so potentially the lease could be terminated. You as the buyer might have paid the purchase price on the fact that you can stay in that location. You're then having to find a new location, causes disruption to the business. So yeah, lease is, well, not in all business sales is not part of it, but if it is a premises-based business, it is critical to deal with that and deal with that early. That's another one. Getting on top of the landlords early, because they take a long time to get back, is another key way to make the sale a lot smoother in the final stages.
Thanks for that, Matt. That's all we have time for by way of questions today. As mentioned, any other questions, please send them through and we'll take them offline and hopefully get back to you. So after this webinar ends, a survey will pop up, and look, we would really appreciate if you could complete it. It only takes about 30 seconds. Essentially, it allows us to get some feedback, because we always love to improve, and also know what other topics you're interested in potentially hearing about. But also, if you're interested in booking in a complimentary consultation, if you've got any further questions for us, or if there's a particular sale or purchase that you wanted to discuss in further detail, please include your contact details to receive this consultation. So we'll be able to assist in discussing what might happen next for you. Thank you so much for joining us today. We hope to see you soon.
Thanks, everyone. Have a good day.